Ever wondered how the costs of acquiring insurance business are shared between primary insurers and reinsurers? Reinsurance commission plays an integral role in this process. Primary insurers are the front-runners, marketing the business and shouldering the acquisition costs. Reinsurers, on the other hand, don't directly contribute to these expenses. However, they do partake in the cost by paying a commission on the premium ceded to them. This reinsurance commission reimburses the ceding insurer for some of the acquisition costs. Now that you understand the purpose of reinsurance commission, let's delve into its different types. First in the line of reinsurance commission types is the flat commission. This is a straightforward method where a fixed rate of commission is agreed upon between the insurer and the reinsurer under the treaty agreement. The calculation is pretty uncomplicated. The commission payable is the premium ceded. That's the amount the insurer passes to the reinsurer, less any returns and cancellations. This amount is then multiplied by the agreed percentage of commission. Imagine a surplus treaty that contains different rates of flat commission for different types of businesses within the treaty. The reinsurance commission for each business type would be the premium ceded under respective heads, multiplied by its respective percentage. That's the simplicity of flat commission. Now let's explore a slightly more complex type, the sliding scale commission. Imagine a commission type that changes according to the loss ratio. That's what sliding scale commission is all about. This method links the commission percentage to the loss ratio, essentially, the ratio of earned premiums to incurred losses. It's designed to align the interests of the reinsurer and the ceding company, incentivizing better underwriting and effective risk management. So how does it work? Well, if the reinsured business is profitable, the reinsurer's commission rate may increase as a reward. But if the reinsured business experiences more losses than expected, the commission rate may decrease, reflecting the higher risk and potential impact on the reinsurer's profitability. During the fiscal year, a provisional commission is typically allowed. This provisional commission is adjusted based on the actual percentage of the commission calculated according to the incurred loss. That's the sliding scale commission for you, providing an incentive for better risk management. Next, we'll discuss the profit commission. A profit commission, the final type of reinsurance commission, brings a reward for profitability. This form of additional compensation is paid by the reinsurer based on the profitability of the reinsured business. It's a contingent reward, calculated and paid when the ceding company achieves a certain level of profitability for the treaty. The specific criteria for determining profit commission are outlined in the treaty contract. Now, there are two types of profit commission. First, the accounting year basis, which is calculated at the end of each accounting year. Second, the underwriting year basis, calculated based on the profitability of policies underwritten in a specific year. And with that, we've covered the profit commission, wrapping up our discussion on the types of reinsurance commission. That was quite a journey through the world of reinsurance commission, wasn't it? We've explored flat commission, sliding scale commission, and the rewarding profit commission, each with unique characteristics and purposes. Remember, understanding these commissions can greatly aid in comprehending the dynamics of the insurance industry. Until next time, keep exploring.